get started. My name is Shadley Gray. I am the head of partnerships and strategy at AMI. For those of you who might not know, Agency Management Institute is dedicated to helping elevate small to mid-sized marketing companies through workshops and tools, and there's all kinds of opportunities on the Agency Management Institute website, so be sure to check out all of that. I am very quickly just going to turn this over to Marcel. I meant to confirm the pronunciation of your last name before we started this, but I think it's Marcel Petipas.
That
Did
was
I get
really good,
that right?
actually, Shadley. Nicely done. You could have
I
lied to me and said that you had studied it, and I would have believed you.
right. So we're just gonna dive in and start the conversation with Marcel. If you want to start with a brief introduction and talk a little bit about your background in your business, and then you are free to take over the conversation.
Amazing. Well, thank you, Shadley, and the team at AMI for having me, and thank you, everyone, for showing up here. I was told that there was an average number of people that attend these things. There are more of you here than average, so I'm going to take that as a compliment. I'm going to take everything that I can in order to get my creative juices flowing here, my energy up. So let me start by saying that I am fully cognizant of what it means to be running a small firm day to day, how time consuming and intense that is, and the fact that you're all here taking an hour of your day to listen to me speak. I don't take that lightly. So, my mission for the next 60 minutes is to try to have you walk away with some actionable takeaways that are going to help you realize the financial objectives that you have in your business. So, real quick, I work with a company called Parakeeto. I started a company called Parakeeto, and we help agencies measure and improve their profitability. And so today we're going to talk about that, how to optimize your profitability. Really quick, I'm from a little place called Prince Edward Island, which is on the east coast of Canada. That's where it's located on planet Earth. In fact, it's such a small place that in this version of a map that I downloaded on Google Images, it's you can't even see it. Where there's supposed to be a fleck of Earth in the ocean, it's not even on this map. That's how small this place is. And the question I get a lot when I travel to speak at seminars is it cold there? And the answer is not right now, but yes, it gets very cold here. And in particular, we get a lot of snow. And so when I was about, let's call it 6, 7 years old, my brother here might have been 8 or 9, we decided one day when there's a snow day, which is a thing that happens a lot here in Atlantic Canada in the winter, where there's so much snow that you can't physically leave your home. It's unsafe to be on the roads. Well, they cancel school. They don't want buses going off the roads. And so we had a day off from school, and we thought, being the entrepreneurial young men that we were going to make some pocket change by going out and offering our very first service to our neighbors, which was shoveling their driveways for cash. So we got our shovels and our snow boots on, and we went to our neighbor's house. We knocked on the door. We said, "Hey, we'd like to shovel your driveway and your walkway for cash." And this is how much we knew about pricing at the time. They said, "How much do you charge?" And we said, "How much do you want to pay us?" And our neighbor, I think being generous, said, "I'll give you each $5 to do the driveway." And we thought, great, that's awesome. We went, we did it. We got our $5, and I thought, man, we are going to make so much money because that only took us a few minutes. So we went to the next neighbor's house, and the same conversation played out. And this time they said, "How much do you charge?" And we said, well, the neighbor next door gave us $5 a piece. And of course, they weren't going to give us less than the neighbor next door. And we rinsed and repeated that for a few houses. And just as we were starting to get tired and thinking about hanging them up, I got a little bit greedy and I said, no, we got to do one more house and then we'll wrap it up and we'll go, I don't know, to the corner store and buy candy with our pocket change. So we went to Miss Harrison's house. Now, Miss Harrison was an older lady. She was widowed, not the kind of person you would see out shoveling her driveway. I thought, this is great. We'll go, we'll help her out, we'll clean her driveway off. And when we offered this to her, she said, "How much do you charge?" We said, "Most people are giving us $5." She said, "How about this? I'll give you a toonie." And I think she felt kind of bad. She knew she was bidding us. And so she went and grabbed us each a sesame snack, which is this delicious little treat that we stuck in our pockets. And we thought, oh, whatever, this is only going to take a few minutes. Let's take the $2. Let's get it done. Now, here's what ended up happening with Miss Harrison's house is below this layer of fresh, powdery snow that had just dropped, there was a layer of snow left over from the last time that it had snowed a few days prior that had turned to this hard bedrock of ice. And it took us hours to chip through this, orders of magnitude longer than every other driveway that we had done before for more money. And I remember laying in a snowbank about halfway through clearing this driveway, chewing on this sesame snack, thinking, what have I gotten myself into? We totally got hosed on this. So this was my first experience at about 6 years old, experiencing what we know today as scope creep. It's a rite of passage. So this is what I want to talk about today. How do we measure and improve profitability in a business model where, unfortunately, we can't always predict our costs? There are nuances to this business model that we run, and I want to make sure that we cover those today. And so just a little bit of background on myself. I run Parakeeto. This is what we do at Parakeeto. We are a consulting firm that helps agencies connect the dots between new business, finance, and operations so they can make better business decisions every day. I also host a podcast called the Agency Profit Podcast, and been a pleasure to have Drew and his thoughts from AMI represented on the show in the past. And I also get to help a bunch of emerging software companies with the professional services side of their business doing this as well. So this is all I think about, is how do you take a service-based business model and improve its profitability, even though it has a bunch of these challenges. So let's dive in to some of the promises for today. There's 3 things that I want to make sure we cover. The first thing I want to talk about is core financials. Right? So because most of you are already spending time and money every month on financial statements, you're probably getting a bookkeeper to do some bookkeeping, you're getting a P&L at the end of every month ideally. How do you get a little bit more value out of that so you can understand if the business is healthy at a fundamental level? And we're going to talk specifically about the AMI model, the 55-25-20 model, as a simple starting point, and then a slightly more advanced version that we talk about that creates a distinction between delivery and overhead expenses that is sort of a level 2 or an extension of that 55-25-20 model. So for those of you that maybe have been doing that and want to take it a step further, get a little bit more insight, we're going to talk about how to do that. Then we're going to talk about the 3 forces, the 3 most powerful forces for improving profitability in your service-based business. And these are non-financial metrics that you can be tracking from an operational perspective on a much tighter time horizon, and use these to predict ahead of time what your financial statements are going to look like, so you're never surprised by those again. And lastly, we're going to talk about specific benchmarks and targets. So you leave here knowing, what does good actually look like? Because this is one of the traps that I see all kinds of people fall into. They'll get onto a webinar like this, they'll learn about a bunch of metrics, they'll go start measuring them, and then all of a sudden they realize they don't know what to do with that information because they're not sure if the number they've got in their business is good or bad, and if they should be trying to get it to go up or go down. So we're going to make sure you leave here with a sense of what good looks like. So is this interesting to you? Like I said before, your time is valuable. So do we want to keep going, or do we want to take 35 minutes of our day back here or 45 minutes of our day back here and go check some emails? Let me know in the chat. Do we want to learn about these 3 things, or would you rather we wrap this up? I don't know how the AMI team would feel about that, but if I was in your seat and I wasn't excited about this, I'd want the time back. All right. You convinced me. Okay, let's do it. So a couple of caveats here. What I'm about to share is simple. It doesn't make it easy. That's true about most things in business. It's going to be true about this stuff too. Figuring out that you have a delivery margin problem or your utilization isn't very high, that's simple. Unfortunately, fixing those things is not easy. So keep that in mind. The other thing I want to point out here is we're about to go through what we call a management accounting framework. So the goal of this is to help you make accurate decisions in your business and do that in a way that is simple, that is cost effective, and that is fast. And the goal is not to be as precise as possible. I could go on a whole other rant about how precision and accuracy are not only not the same thing, they're often in tension with one another. And often, actually in operations and service-based businesses, the pursuit of excess precision is what reduces the level of accuracy in your reporting. I won't go down that rabbit hole, but just understand that a lot of these metrics I'm going to share today, they're simple. That's the point. They're simple because that's what's quick and easy and able to get you to the thing you need to know with the level of accuracy that's necessary for you to make the decision and move things forward. That's what we're optimizing for here today. And last but not least, this is a management accounting framework. This is not a tax-based framework. This is not a GAAP-based framework, right? So the goal here is not reducing your taxable income. That's an important thing, and I hope that you have a person that helps you do that at the end of the year. It's also important if you have fiduciaries that you need to report to, that you're doing that in a way that's compliant with GAAP or whatever framework you're beholden to. But The thing that tax and GAAP-based accounting have that is different from a management framework is the objective of those two frameworks is not to give you a truthful representation of what your business looks like. The objective of tax-based bookkeeping is to obfuscate the profitability of your business to the lowest possible reasonable representation so you pay as little tax as possible. That's the incentive structure. And with GAAP, it's kind of the opposite. It's to give the most beneficial representation of the performance of your business so your fiduciaries can get an understanding of how well you're performing. Management is really geared towards truth. So all of this to say, this might be a little bit different when you go and apply this to your books. It might be different than what you've been seeing before. I encourage you to consider what lens has been being applied to your books in the past, and that this might be a little different. So with all of that in mind, let's talk about core financials. How does your business make money as a service-based business? So this is essentially how we think about it at Parakeeto. You first have to consider how much agency gross income does your business produce. So AGI stands for agency gross income. And so this is a term that was popularized by Drew and AMI. So those of you that are kind of in the framework, you'll understand what this means. Now, what exactly does this represent? Well, it's your revenue minus what we would call pass-through expenses. And so just to define this really quickly, pass-through expenses would be money that you collect from clients that isn't really yours to keep. It passes directly through your business onto external vendors, and you're not really responsible for the profitability of that money. So common examples of this would be print budgets, advertising or media budgets. If you were producing a video, for example, but you don't do production in-house, you always hire a third-party production company, that third party would likely be a pass-through expense. Travel or other hard costs typically fall under pass-through. So it's important that we isolate these things because for some of you, this pass-through might be really material, and it might be skewing your sense of how big your business actually is and what appropriate levels of spending are within the business. Just to give you an extreme example of this, we had worked with a firm that thought they were a $6 million a year firm. They produced a lot of events. And what we figured out was they were actually an $800,000 firm, right? There's nothing inherently wrong with that. The problem was their payroll was like $1.3 million on its own. So clearly this lens they had on their business was causing them to spend in ways that were not actually reasonable for the true size of their business. So step one, understand what your agency gross income is. How much of the revenue that you collect from clients is actually yours that you now need to earn with your operation as a firm. And then the question that we want to ask after that is, well, what is it actually costing us to earn that revenue? And this is where we want to pay attention to delivery cost. And delivery cost is generally going to be made up of payroll, directly attributed to delivery, and what we would call shared delivery expenses, which are the tools and software and other materials that your delivery team needs to do their job every day. And the goal is generally to keep this to under 50% of your agency gross income. And I'm going to tie this back to the 55-25-20 model here in a moment. So if we can accomplish this, what this essentially means is we have what we would call a delivery margin of 50% or more, meaning that for every dollar of agency gross income we collect from clients, we have at least 50% of that dollar left over to cover overhead and leave a profit in the business after we've completed the promise work for clients. So that then leads us to overhead, where we are generally going to spend another 20 to 30% of our agency gross income. And this generally boils down to admin being anywhere from 8 to 14%, sales and marketing being another 8 to 14%, and facilities, for those of you that have it, most of us are remote today, this is 0 to 6%, with the important thing being we try to keep this to between 20 and 30% of the business's operating expenses. And if we do that, we should be setting ourselves up for anywhere from a 20 to 30% profit on agency gross income. So this is sort of the ideal model. Now, here's the catch with this. This model is a little bit different than what we're used to seeing, which is 55, 25, 20. This is sort of the AMI gospel. In fact, so much so that I think somebody has this tattooed on their body. This is what I heard at the last Baba Summit that I was at. Somebody actually had this tattooed on their forearm. And so this is generally a representative of payroll, overhead, and profit. So what you can see here is that these numbers check out. There's perfect alignment here. And then generally in AMI's model, what we're talking about is all of your payroll, should be 55% or less of your agency gross income, and all of your sort of hard overhead expenses should be 25% or less of your agency gross income. So here's the thing that I think is brilliant about this. Most of you, when you go look at your profit and loss statement, all your payroll is in one big account called payroll. And there's not usually going to be a differentiation between how much of this payroll is for delivery and how much of this payroll is for overhead. And similarly, a lot of your overhead expenses, it'll be fairly easy to figure out, what are all the hard costs that go into our overhead. So this is geared towards the way your profit and loss statement is probably already set up. And it's basically going to be impossible to get to 55% or less of your agency gross income being spent on payroll without also accomplishing a 50% delivery margin. So it's sort of this forcing function for you to get to the right ratios. Now, the reason we are proposing today this kind of next step function increase in complexity, but increase in insight, is if you've been trying to get here for a while and you haven't been able to do it and you're not sure why, or if you've gotten here but you're looking for more insight, the next step is for us to really separate what are you spending on delivery from what are you spending on overhead. And what this starts to require you to do is take some of these accounts in your financials that are generally going to be representative of both of these things and start to split them apart. So payroll can no longer just be one big account called payroll. You have to start differentiating between who's doing delivery work, who's doing overhead work, and who's doing both, so we can allocate their salary to each of those departments. And that starts to give us a really clear picture of how much are we truly spending on overhead and how much are we truly spending on delivery. And it exposes where there's actually an issue. Do you truly have an overhead spending issue, or do you have an issue with the margins that you make fundamentally as a business doing the work that you do? And for 95% of the companies that we've audited over the last 7 years at Parakeeto, this is where the issue tends to lie. The company is failing to get to their profit goals, often because they're just not generating enough profit at a fundamental level with the machine that accepts money from clients and then delivers on those promises. That machine is not efficient enough at earning revenue. And that's where the rest of our conversation today is going to be focused on: how do you improve delivery margin and really the fundamental profitability of the business so that you have more optionality in terms of reinvesting in overhead and or having a profit. To the degree that you can improve this number, you improve your ability to be profitable, or at least you improve the ability for you to choose to be profitable. So I'm going to take a quick pause here. I've been talking for a very long time, according to my AI note taker, and a lot of it has been spewing numbers at all of you. So do we have questions? Is this making sense? Are we tracking so far? Give me some signs of life in the chat. 84 of you are still here. Stephen, this is Notability, and I'm actually just using a Stream Deck to put this up on Zoom, but I could just share my screen as well. All right, this is making sense. Everyone's tracking so far. At least a few of you are tracking so far. Okay, awesome. So here's what I want to cover next. Assuming that you leave here today, or maybe you've been doing some math on the back of a napkin here as we've been going through this, and you've figured out, like, I'm not hitting these ratios or these ratios. How do I improve my delivery margin? We're going to talk about the 3 immutable forces, the only 3 ways to improve your delivery margin, and how to think about those numbers, and we'll even go through some examples of how they increase your delivery margin. So when we think about this metric, delivery margin, let's first revisit the formula. So it's agency gross income minus your delivery costs over agency gross income. So just to give you an example, if we had $1 million firm that spent $400K on delivery, we would have a 60% delivery margin in that firm, which would be very healthy. Okay. So there's really, at a high level, 2 ways to improve this. and I'll color code it here for simplicity. Obvious thing number one is we can make more money without increasing our delivery costs, right? So we could charge more, we could increase our capacity to do work and take on more clients, right? There's a number of things that we can do. We'll talk about metrics we can use to drive that outcome. The other way, of course, is we can spend less money on the people and other costs to get the work done without relatively decreasing the amount of money that we actually earn. So those are the fundamental levers. And let's talk about some ops metrics that we can use to actually get to these outcomes. So the first one is what we call ACPH, which stands for average cost per hour. Okay. And so this is really a proxy for delivery cost. And so the way we think about average cost per hour is the following. For any given subsection of the business, this could be one individual or it could be a group of individuals, we want to take the total payroll. This would include benefits and all the other sort of tangential costs of employing these people. And we would want to divide that by total capacity. And we'll define total capacity here really quickly. I want to give you a little trigger warning. There's a project manager or a former project manager that's on this session right now. They're going to have an aneurysm when I explain how I use total capacity in this metric, and then I'll explain why we do it that way. So total payroll is total compensation plus all the benefits, et cetera. Total capacity is all of the time that you buy from someone in their employment contract. For most people in North America, that's 2,080 hours a year, or 52 weeks multiplied by 40 hours. And here's what the PM just thought. But Marcel, nobody works 52 weeks a year and 40 hours a week. What about time off? What about holidays? What about sick time? What about non-billable time? What about all the non-billable people in here? And you are absolutely right. We have to consider the cost of all of those things. My argument is you should not be doing it here for all kinds of reasons. The first reason is it's going to make this metric horizontally inconsistent. So now we can't actually compare our cost basis on a project from 6 months ago to a project from today, right? Because our cost basis is fluctuating based on externalities. And it also makes the cost of calculating this metric, which is going to be used thousands of times in our operational framework, it dramatically increases the cost and complexity of calculating it. So we absolutely are going to consider all of those costs. We're just not going to do it with our average cost per hour. We're going to do it somewhere else. And it's still going to be accurate, but we're going to make it simpler. So just to give you an example of what this looks like, if I had a strategist, they got paid 120 grand a year, their capacity is 2,080 hours. That means their average cost per hour is just under 58 bucks an hour. If I wanted to make, let's call it a 70% margin on their cost, I would need to target an average billable rate of $192 an hour. If I had an intern that cost less than half of what they cost, then I could charge less than half and still make the same margin. And if I was to have them both equally utilized and sharing work, then I could charge $140 and still have the same margin. So you see how changing the cost per hour can allow you to achieve a certain margin, but at different rates. So this is vector number one for improving your delivery margin, is you can focus on decreasing the average cost per hour of labor in your business. And to the degree that you can do that, what you should be able to do is control delivery costs and either decrease them as you maintain your agency gross income, or if you have a staffed team, what's more likely to happen is that as your agency gross income increases, your delivery costs will increase less incrementally. So over time, you will create a separation between these two things. And the way that that happens in practice is, well, we used to have to hire 2 senior people and 1 junior person in order to take on this much additional work. And now we actually need 2 junior people and 1 senior person, which has decreased, the amount of incremental delivery costs that we would take on to bring on the same amount of revenue by whatever that percentage might be, 30, 40, 50%. And where you'll see a faster impact is if you have a lot of freelancers or contractors on the team. Because you're paying for their time on a much lower latency, then you might see a much quicker change to delivery cost on that flexible part of your labor. So that's big idea number one, is one way to improve delivery margin is to increase the efficiency of the cost side of the business. You do that by looking at all the different things that you do and figuring out, how do I drop the average cost of an hour on this type of project, on this type of client, on this type of work? And to the degree that you can do that over time, you should be able to control your delivery costs. And the simple principle here to think about is how do I decrease the level of judgment required to get a certain task done or to get a certain outcome to the client? And that could correlate to improvements in technology, documentation, process, all the things that we're all talking about all the time, training, professional development, etc. And to the degree that we can make it easier for a person with less experience to get similar high quality outcomes, generally we need to hire less experienced people, and less experienced people are generally going to be less expensive. Those are all generalizations, but they stand to be fairly true in most cases. So that's vector number one. It's actually my least favorite, the least exciting to me. I want to talk about my most exciting and most favorite levers, which are average billable rate, and then my last metric, which I'll keep a secret for right now. So average billable rate, ABR, is the second metric we want to talk about, and that is a proxy for agency gross income. So the way we think about average billable rate is, again, for any subsection of the business, could be one project, could be a group of projects, clients, services, products, for any time period, could be a week, a month, a quarter, a year, doesn't matter. All we need is two inputs. How much agency gross income did we collect across that segment that we're measuring? And how many delivery hours did we need to invest to earn that income? Now, notice I didn't use the word billable hours. That's by design. A delivery hour and a billable hour may be the same thing in your organization. A lot of times they're not. I don't care in this equation how many hours you billed the client. What I care about is what you got paid, completely independent of your billing model. I don't care if it was flat rate, value-based, percent of ad spend, time and materials, weekly sprints, daily rates, a combination of any of those things, doesn't matter. Just what did we make? And then how many hours did we spend to get it done? Completely independent of how it impacted the billing model, if the client got charged or not, doesn't matter, right? How much did we earn? How much time did we spend? That gives us an effective rate. So here's an example of how we might use that information to compare a few projects together. For example, you could see here that we had the website build. If I asked 10 clients, which project was the most profitable without this information over here, most people would point straight to this one because the revenue number is the highest. But the important consideration here is what amount of time did we have to spend to earn the money that actually belonged to us? And based on that, what was the amount of revenue we earned per hour of effort? And then you can see here that when we actually sum these columns and then run that formula, we end up with this $115 average billable rate. And the reason for that is the website build was a larger share of the revenue. Therefore, it had a more significant weight in terms of calculating the total. And this could stimulate a really interesting conversation with the team, no? Like, hey, what can we learn about this website build? What could we have done better? Is there something about our process that's inefficient? Did we miss something in scoping? Is there something about onboarding we need to change? And similarly with the funnel build, we might say, hey, like what can we learn from this? How is it that we're so efficient? Is there anything we can take from this and apply to other projects that we do? Is there a way that we can be selling more funnel builds? Because the reality is, if we have a certain amount of capacity on our team that's available and we could sell all of it for twice as much money per hour, we would make twice as much money. I know that that sounds a little too simple to be true, but it's not my opinion, it's just math. That's how our business model works. So average billable rate is an incredibly powerful metric in the sense that you can increase your efficiency at earning revenue by either, of course, charging more money. Great, we've all heard that. Many of us have tried it. Awesome, if that's an opportunity for you, go ahead and do it. But the other thing that is equally as powerful is getting more efficient at earning the same amount of income, especially in instances where we have some abstraction from time in our billing model. So if we can get something done in half as much time, we effectively double our efficiency at earning revenue. Kylie Peters, do I include non-billable, i.e. finance, in the ABR? So the answer would be if that time can be tracked against, if it's directly attributable to the client work, then it counts. So if in terms of finance, it's like if your finance team is tracking how much time they spend invoicing clients, and if that is estimated when you're actually pricing this project out, then I would say yes, you would include that time. But what we're not including here is, time that is not related to client delivery at all. So like your sales and marketing time, that's certainly not included here. The time you spend filing your taxes is certainly not included here. What we're really trying to figure out here is for a given segment that we're measuring, how much money was collected and how much time was spent doing the work that we got paid for directly here. And where does owner's comp belong in these equations? Well, for delivery hours, anybody whose time is spent here is included there. If we go back to these original formulas, owner's compensation is attributed to wherever it belongs. So I know that's kind of a non-answer to your question, but the answer is if as an owner you spend 20% of your time overseeing the delivery team, then 20% of your salary goes to delivery. And if you spend the rest of it in overhead, you would attribute it to overhead. And if you want to get specific, you can split it across these functions. In this example, what is the difference between project revenue and AGI per project? Stephen, great question. I could give you some theoretical examples. So for the website build, let's say, for example, we hired a dev shop to come in and do the development on this website, and we never do dev internally. We don't even have a dev team. So in that case, if we spent 20K on the dev shop, that would be a pass-through expense. For brand design, let's say we went out and we actually bought a bunch of materials for this. Like we licensed some fonts, or we bought some super expensive Pantone color for this particular brand, and we spent $5,000 on that. That would be a pass-through cost. For the funnel build, let's say for the funnel builds, the way that we've designed the service offering is that we only do this strategy, and then we hire a third party to go and actually do all of the implementation. We're like partnered with some HubSpot team, and we always just hire them as a third party contractor. In that case, that could be the pass-through cost. So hopefully that's helpful. All right. I've covered a few questions. I want to give you guys a bonus here. I call it Kirkland brand delivery margin. So here's a little magical thing. If you have an average cost per hour and you have an average billable rate, you can get a quick sense of the delivery margin for anything that you sell. It could be a project, it could be a client, it could be a service line, it could be a product, it could be any cross-section of work that you want to evaluate and compare in your business and get an understanding of, roughly what delivery margin are we making on this work. If you have average billable rate and you have average cost per hour, you can get a sense of what that looks like. And what I love about this is you don't need to wait for your accountants or your bookkeepers. You don't need to go through the finance department. This is information that is available to you from your day-to-day operations that you should be able to pull very quickly, very easily. Because remember, all we need to understand is how much did we get paid and how much time did we spend on it. And similarly, for average cost per hour, all we need to understand is how much do people get paid and what is their capacity. This is like stuff that you can pretty easily calculate using a spreadsheet, using data that's at your fingertips, and you don't necessarily need to be bottlenecked by finance, whose job is to make sure you stay out of jail. So they've got to do things in a certain way, and that's part of the reason it takes a few weeks at the end of every month to get that information. So using those two inputs, you can start to give yourself a really good sense of where are we making money? Where is our margin being created on our client work without a whole lot of cost and complexity? So being mindful of time here, I know I'm ripping through this. We have one last metric that is very important here, the last force that controls delivery margin. And that force is a metric that gives a lot of us hives when we hear about it. It's utilization. Some of us have had a bad experience with utilization. I get it. It's the dark saber of agency metrics. For those of you that are Star Wars fans, it has great power, but in the wrong hands, it can do great harm. What is utilization? Well, it's fundamentally a measure of how much of the capacity that we pay for is being used to earn revenue. In other words, is being used to earn an average billable rate. So the way that we think about this within this framework is we have delivery hours. Again, I don't care about billable hours. I care about how much time the team actually spent earning revenue. And I divide that by total capacity. So remember, when I define total capacity for average cost per hour, I'm doing it exactly the same way here. This is all of the time that we're paying for. And if you're measuring the whole business, this includes everyone on the team, including people that do zero client work, if you have them on the team. And this is where we're going to now actually account for the cost of time off, holidays, non-billable time, non-billable people. We want to see that reflected in our utilization rate. And here's an important sort of aside. There are going to be people in your organization that may look at this and think, well, this isn't fair, right? If every time someone takes time off or has to do internal work, their utilization rate's going to drop. That doesn't seem fair. Well, and that's sort of a subjective question. this is where there might be other versions of this metric that are useful to a project management team, for example, who are being held accountable to how good of a job they do at resourcing the available capacity in the business. That's a different question for a different purpose. But the reality is, if people take time off, that does decrease our utilization. It certainly doesn't increase it, but if we were subtracting time off from capacity, then our utilization rate would go up the more time off people took or the more non-billable time they took. That's a false positive. So we cannot have the metric function this way if the question we're trying to answer is profitability related. So keep in mind that in our framework, this is how we think about utilization, with the purpose being a management accounting lens on the profitability of our business. That doesn't mean that other ways of measuring utilization aren't useful for answering other questions. I just encourage you to be clear about the different purpose that that might be serving, and probably call it something else or append some kind of other, extension on that metric so that your PM team knows that you're talking about different things. Anyway, that's my rant on utilization. Let's talk about this in a practical sense. Here's an example of a utilization report that we could run where we get a sense of how much capacity each person on the team had. We can see here that Rochelle's part-time, how many delivery hours they worked. So again, not billable hours necessarily, but how much time they actually spent doing client work, regardless of whether or not it influenced how much the client paid. And in the end, a total utilization for the team and individualized utilization rates for each person. Also keeping in mind that some of these people may not have a very high utilization target because, again, maybe only a small portion of their job is doing client work and the rest of their time is supposed to be spent elsewhere, working on sales and marketing, doing administrative things, or maybe even actually serving in more of an overhead function within delivery. So with all that in mind, here are some targets. Here's how to think about this. This might surprise you, but we generally expect agencies, when we look at their whole team for a whole year after factoring in the cost of time off and holidays and all those things, we expect most firms to land somewhere in the 50 to 60% utilization range for their whole team. I know that that seems low, but that's because it's the reality of how much time actually ends up having to be spent in other places that are not doing client work. When you take into account the fact that pure producers are going to fall somewhere in the 60 to 75% range on an annual basis once you strip all that stuff out on a regular week, hopefully they're in the 75 to 85, maybe 90% range. You're going to have delivery managers, so your PMs, AMs, head of design, head of engineering, et cetera, that are going to do some client work, but they're actually going to spend most of their time working across the entire team, across huge swaths of clients, and their time's not really going to be directly attributable to individual clients or projects. And then you got other people in the business that might not do any client work. And when we blend all that together, this is sort of what it looks like. So those are the three levers. I want to bring this together in a practical example, just so you can really get a sense of how this actually impacts profitability, because all of this has been somewhat abstract. We have a firm here, they have 100,000 hours of capacity. So that's, roughly 50 people on the team. They spend $3 million a year on delivery. So that's payroll and other expenses related to running the delivery function in the business. And they have $1.5 million in overhead. So that's salaries and, other expenses related to sales and marketing, administration, facilities. So let's go through some examples here. In example one, this company has a 50% utilization rate and $100 per hour average billable rate. So this is a pop quiz. Can anyone tell me in the chat how much agency gross income this firm can earn with those metrics? Now I'll walk you through the math. We take 100,000 hours of capacity, we multiply it by 50%, so that's 50,000 hours. Then we multiply those 50,000 hours by $100. That's the average amount of revenue they'll earn for every hour they spend on client work. So the answer is, if anyone's good at math here, $5 million in agency gross income. Pretty cool. $5 million. Awesome. Delivery margin. They're going to spend $3 million to earn that $5 million, which leaves them with $2 million left over, or 40% of their agency gross income. We said we wanted to be at 50%, so this is okay, but it's not great. And then they're going to spend another $1.5 million to run the business, pay for overhead, which leaves them with a $500,000 profit, or 10% of their agency gross income. So this is a pretty normal outcome. When you adjust for market rate founder compensation, et cetera, this is roughly how most firms are performing. So let's talk about some simple ways that this firm, again, simple but not easy, this firm could improve their performance. The first thing we're going to do is go from a 50 to a 60% utilization rate. So now we have 60,000 hours that can be deployed against client work. And let's assume that nothing changes about our average billable rate. This firm can now earn $6 million in agency gross income. They'll have $3 million of it left over, which is now 50% of their agency gross income. And their profit, assuming that they choose not to reinvest any of that additional cash into overhead, is going to be $1.5 million, which is a 25% margin. Okay. Now, let's assume that we can maintain that 60% utilization and we increase the average billable rate to $125 per hour. Maybe there's some pricing changes there, but let's assume that a lot of that comes from actually just spending less time to get the same things done. This firm can now earn, with this business model, $7.5 million in agency gross income. They will have $4.5 million left over, which is a 60% delivery margin, and they will have $3 million in EBITDA, which is a 40% EBITDA margin. Again, assuming they don't choose to reinvest any of this in additional overhead, which at this point is 100% their prerogative. Notice that we haven't talked at all about decreasing overhead costs or delivery costs. We haven't touched the cost side of the business. The only thing we touched were the two levers for agency gross income, utilization and average billable rate. But this is the kind of impact that these metrics can have on the performance of a firm, just by increasing the level of efficiency with which this firm earns revenue. So that is sort of the big idea for today, and the thing that I hope all of you take away, which is that delivery margin is the most important metric for improving profitability, making sure you have a healthy relationship between the money you get paid and what it costs you to earn it. And that ultimately there are three important levers to improve that: average cost per hour, utilization, and average billable rate, which can be measured independent of your financials and really help you get a grasp on where the opportunities are from an operational perspective that lead to this kind of an outcome. And to the degree that you can do that, you empower yourself to make choices about investing back in overhead, to buy back your time, to grow faster, whatever the case might be, or take more of that profit out of the business and compensate yourself for the risk and sacrifice that you made in building this firm, or perhaps gearing up for an exit, whatever that prerogative is for you. So with all of that, I want to make sure we open it up for Q&A. I'm sure there are lots of questions. Many of you are very detail-oriented people, so let me know in the chat if you got some questions. Shadley might be moderating here a little bit as well. And while we wait for those to roll in, I'm going to do a shameless plug. If you want to go deeper into all of these ideas and get some free resources and tools, you can head to parakeeto.com/toolkit, where I put together a little free course that has all kinds of things in it: videos, tools, cheat sheets, templates, spreadsheets to help you implement a lot of the stuff that I talked about today. All right, let's go to questions. Who's got questions? There are a few good ones earlier I think I've addressed. Let me just scan back through the chat, make sure I didn't miss anything. All right, Heather's got a question here. How would I advise that a firm aims to eliminate time tracking and move away from the billable hour altogether? Excellent question, Heather. So the first thing that I will point to here is that, and maybe this is what you're getting at, maybe it's not, but there's time tracking and then there's billing by the hour. Those are completely independent concepts that are not related at all. So moving away from the billable hour, that is a question of, from my perspective, really trying to move service offerings on what we call the agency pricing quadrant. So when you think about the utility of time materials billing, you have to consider, oh, there goes my timer, the value of work, right? So is this work high value or is this work low value? And then the other thing that you have to consider is risk. And risk is really where there's the biggest implication for time tracking. And generally what we see is that when you are selling high risk work that is low in value, this is where you tend to get stuck in time materials billing. And when I talk about value, I really talk about it from the perspective of the client. And the two biggest things that influence value are really the number of alternatives that that client has to you to do this thing. And positioning is one of the most important things that influences that. You could be selling graphic design services. That's going to put you immediately in a highly competitive space. But if you specialize and say, we help B2B software companies visually communicate complex data systems using design. That's still graphic design, but the positioning means that there are fewer choices for a firm that's trying to solve that problem. And then the other thing, of course, is the relative impact that it has on them. So like, is this a $100 million problem for this business, or is it a $10,000 problem for this business? And that is going to influence the degree to which they're willing to pay for the outcome. Now, if you can move even just up to more high value things, even if they're still high risk, meaning you can't really predict what the scope is going to be, or there's going to be a lot of variability, you can still move to abstracted time and materials, which allows you to maintain some of the risk sharing benefits of time and materials billing, because that's the reason that it's good, right? The good thing about time and materials is that you're getting paid for your time. So if it takes more time than you thought, or if you just can't predict the amount of time it's going to take, or if the process that you need to use to solve this problem is inherently iterative, well, that's where you're going to be happy that you were billing for time, because you have less risk in the engagement. As long as your margin on time is good and you get paid for your time, there's no reason you can't be highly profitable with this model. And the biggest holding companies, the biggest consulting firms on the planet, all predominantly bill this way. So there's nothing inherently wrong with it. But if you can move up to more complex, more high value things, you can abstract at two vectors primarily. The first is the time unit. So that's selling days, weeks, bi-weekly sprints, months. And the second is at the team level. So an example of this would be, hey, our software development team is $20,000 per bi-weekly sprint. And there's multiple people grouped into that. It's spread over a long time horizon. So you get some of the benefits of having high value, and that you can have a higher rate. You can still benefit from being more efficient while still maintaining some of the high risk sharing benefits. And then when you get to high value, low risk, this is generally value based pricing, and low value, low risk, this is generally flat fees. So this is how I would encourage you to think about trying to move away from time materials, is how do you move your service offerings into a different quadrant? And then in terms of time tracking, I think it's irresponsible to run a service-based business without a model of where your time is going, but that doesn't mean that you have to use timesheets to develop that model. And if you can lower your client dilution, meaning go from having your team spread across a whole bunch of different clients at once to having people resourced against a very small number of clients within a given period of time, you can start to move to more of a resource plan based time tracking model, where instead of having the team fill out individual timesheets, you can have them essentially have their time tracked by the project manager, which is responsible for maintaining a reasonably accurate model of where people's time is going via a resource plan. So this person was assigned to this client for this day for 6 hours. Tomorrow they're working on this client for 6 hours. The less dilution you have at any individual contributor for the number of clients that they work on at a time, the more viable that model becomes. And if you have your team jumping around between 5, 6 different clients every single day, timesheets are pretty much the only way to get there. And I would not encourage you to try to move away from timesheets, because without that information, you cannot get insight into margin at any more granular level than the financial basis of the business. And I've not spoken to a single firm that, they say publicly, we don't track time. I've never met a firm where that was actually true. All of them track time. It's just that most of them use timesheets to do it. So hopefully that answers your question. We have a bunch more questions, so let's see if I can rip through those. What is a good what is a good benchmark for founder CEO salary for a $1 million agency? I pay myself via owner's draw, not salary, so adding salary into delivery costs is something I need to do. Yeah, great question, Will. The benchmarks around this are a little bit difficult, but I would say at least $100,000, and I would say the top end of that would probably be closer to 200K, the medium being somewhere in the middle. That is generally what we have seen. Steve, could you adjust or combine the average cost per hour and utilization? Instead of dividing by 2,080 hours, you could divide by, which assumes a 50% utilization. Steve, you could do that. I just don't see why you would. I would just account for the cost of utilization in your margin target when you're pricing out work. Because the risk with having utilization tied into your average cost per hour is that utilization is constantly going to be fluctuating. It's both literally going to be fluctuating, but also it's going to fluctuate in your business model every time that you make a staffing change or you change someone's role. The sort of model for what your utilization is going to look like is going to change. And what that creates is, again, horizontal inconsistency where you might have two projects with identical profitability, one from 6 months ago and one from today. They're going to look like they had different levels of profitability for a reason that has nothing to do with the profitability of that project itself. And it has to do with a change in your business model that is independent of the performance of a given project. So I don't like having things like utilization or overhead influence the cost basis of projects because it actually decreases the accuracy of your measure of project performance and makes it harder to compare over time and spot trends over time. So I would just encourage you to take, the cost of utilization and just factor it into your margin target. This is why we generally encourage you to target a 70% or higher margin on your cost per hour when you're thinking about the effective rate you're targeting, because it allows you to compensate for the amount of time that's not going to be utilized, plus, your overhead and all those other things. So hopefully that answers your question. You can go ahead and do it. We don't do it for that reason. Best practices for getting compliance on proper time tracking. The biggest one, Stephen, is close the loop. So I would start with just an average billable rate report. So like start building this report and talking to your team about it. And you're either going to come to one conclusion, which is, wow, guys, like we're so efficient at getting work done. It takes us half as much time as we thought. So I'm going to go sell twice as much stuff next month and not hire any additional staff. And then your team's going to be like, well, hold on a second, Steven. Maybe all of our time tracking isn't making it into the system. And then you can have a conversation about like, well, wow, I'm so glad you told me that. Like, this is how this information actually gets used to make decisions. And the other side of that could be that they're over reporting on their time. And then you're having sort of the opposite conversation, which is like, wow, we really have an issue with over servicing and, we need to find a way to get more efficient or we're going to have to restructure the team. But the biggest thing here, Stephen, is I would close the loop and try to make sure that you have a balanced conversation with the team, because until they can see how the data that they put into the system actually influences them and how it's being used to make decisions, then it's always going to be a bit of a black box and you'll always struggle with compliance. We could talk about tactical things, but that's the most important one in my experience. How did I calculate my target for ABR? I based that on a 70% margin. So effectively what we would be doing here, David, is we take our average cost per hour and we divide it by 1 minus our margin target. In this case, our margin was 70%, so we would take 0.5769 divided by 0.3, and that should give us $192. I'm going to do it on my phone right now just to validate that I'm not full of it. Wouldn't that be funny if I was completely wrong? No, that's exactly what I did. All right. How do high retention billable employees factor in? Some of our least efficient FTEs have the best client retention, which has value over time. Aaron, what do you mean by that? Like, I would measure their efficiency based on how much revenue they earn relative to the delivery cost. So if what you're saying is true, that should be, it should be true about them. And they would actually be efficient in the sense that they're probably earning that revenue in less time. So their utilization would be lower, but their average billable rate would be higher, which is good. That's better than having their average billable rate and their utilization be on target. I'd rather have a higher than target average billable rate and a lower than target utilization and still end up with the right delivery margin. It's actually a better situation. What tools or methods are you using to forecast utilization more accurately across variable scopes like retainers and ad hoc projects? Rachel, that's a great question. This is where I think differentiating between top-down and bottom-up forecasting is super important. And I don't have time to get into that today, but I have an article that I wrote all about this that I will share in the chat if I can just find it. Actually, it's a whole podcast episode that we did on this exact subject. But the big idea here is that we want to really simplify how we think about forecasting so that we can do it based on these highly fluid probability-based outcomes as opposed to these highly detailed sort of bottom-up assumptions about who's doing what every single day. So I'm just going to reply to your comment with a link to that. Hopefully that answers your question. Will I share this board? Yes, I can share the notes, no problem. The AI has gotten takeaways from this, so I'm happy about that. Maybe the answer to my question is to measure things annually rather than monthly, or even over 2 to 3 years. Yeah, that's an interesting one, Aaron. You're welcome to reach out to me if you want to like chop this up on LinkedIn or something like that, get into a little bit more of the nuance. I'm happy to try to get a little bit more specific to what you're trying to measure there. These are some great questions. I am trying my best to like rip through all these. It seems like I've gotten most of the questions, and hopefully these answers have scratched the itch that all of you have. If there's any last questions, by all means, reach out to me. But I think with 2 minutes left, we won't chance it. So again, free stuff. If you want to dig into this, head to parakeeto.com/toolkit. If you want to connect with me, I'm on LinkedIn, Marcel Petipas. I'm not hard to find, and feel free to send me a DM if you have more questions after the session today. I'm happy to be helpful however I can. With that, Shadley, anything you want to close out with?
I will put my email address in the comments if anyone has, or in the chat if anyone wants to follow up or get any additional information. This has been recorded and will be on the AMI website in probably a week, about a week. If you wanted to follow up with me on that, you are welcome to do so. There is my email. Other than that, I think it was a ton of really great information. I think there was a lot of engagement as far as questions. So obviously you were hitting on a bunch of things that have been on the minds of our agency owners. So this has been fantastic. So yeah, I think it was great.
Thank you.
Do you have any last minute comments before we jump off and get
No,
back to our day?
just want to thank you, Shadley, and the team at AMI for having me, and thank you everyone that showed up. Thank you for the questions and the engagement. Again, I hope that this was helpful, and just reach out if I can answer more questions offline. Thanks so much for your time.
Yeah, thank you, everybody. We'll be back in 2 weeks with another session. And until then, everyone have a great summer, and we will reconnect soon. Thanks again. See you.